All right, guys. In line with my idea that I want to upload videos covering a range of different asset classes, not exclusively just Bitcoin, I'm going to do uploading a macro video for gold, USD. And right now we're looking at the gold quarterly chart. Um, again, quarterly is every 3 months, very important from an institutional perspective. I upload a video on quarterly shifts and quarterly opens and closes. Check that video out if you haven't seen it. Um, but gold is a video. I could do a whole series on gold because there's a lot to cover here. And so I probably won't be able to fit it all in one video. But I just want to start from the very, very big picture about, my fundamental view on gold, and then I'll sort of dive into the price action. Now, gold, currently the price action on gold, it's hard to get particularly bearish on the price action just based off what we're seeing. Um, but before I dive into that, I just want to cover some of the fundamental aspects of the market. As you can see, gold essentially has gone up on a fundamental level for most of its existence. If you go further back, Awanda price chart starts at '07, but if you go much further back, you can see that this is a very sustained uptrend since from very long ago. But for the purposes of what we're discussing, we really only care about what happened after the '08 financial crisis. So, whether you mark that as the summer of 2008, roughly there, this dipped down, probably more in line with July, summer of '08. But that's really where the market changed. And that's where I kind of anchored the left side of all my macro charts to that moment in time because it really was one of those black swan events that changed the entire market picture. And, everything has been different since then. So it's a good anchor to the left side of your macro chart. Now, one of the reasons why I'm not a huge believer in gold is because, you know, um, kind of what it's done after '08. So if you see, we can go here to the Fed's balance sheet. This is another one of the most important charts you can look at. You essentially have the '08 financial crisis, and you can see how, the Fed's balance sheet has just gone uh, parabolic with the beginning of quantitative easing there. And then, more recently with March 2020, the madness, it's just, things are just getting very parabolic in the Fed's balance sheet. Now, if we go back to gold, you see after the quantitative easing, it did mount a rally, but it gave up the ghost on that rally right around July 2012. And if we go back to what the Fed's balance sheet was doing here, you know, I guess what I'm trying to illustrate is that the Fed's balance sheet increased basically 3x, right, from 3 million to 9 million. And if we go to the gold chart, from 2012 and the Fed's balance sheet increased 3x, gold is essentially, for all intents and purposes, at the same price as it was in 2012, which is not great if you're looking at it as a store of value. Um, Essentially, if you were to chart this against SPY or the U.S. equities index, whenever you look at a U.S. equities index, you're measuring it against uh, the U.S. dollar. But if you were to graph it, the U.S. equities index against the Fed's balance sheet, you can see that the uptrend in equities doesn't exist if you trade it against the Fed's balance sheet. It's actually just trading in the trading range the whole time. Um, and the uptrend is more reflective of the debasement of the currency it's trading against than an actual uptrend in the value of the underlying equities in the companies. And but on gold, we see an inability for gold to maintain that, even its uptrend against the currency debasement. Again, I'm talking on the macro to keep pace with the Fed's balance sheet. So it's just something to think about. I don't really want to dive into all the reasons why gold is not, inferior to Bitcoin, but pretty much along every monetary property, gold is inferior to Bitcoin. I guess the one exception being the liquidity that exists in the market. Gold has a larger market cap, so it does have more liquidity than Bitcoin does. Um, but how long that stays true, I'm not entirely sure. Uh, so anyway, if we just dive into price action, we can see that price really started to take off on a macro level in April 2019, and it's rallied pretty significantly. Um, if you're just looking at pure price, kind of cooled off a little bit here, rallied down into this big level here, which was essentially the high prior to the March 2020 dump. You can see this is a big level we want to mark off on the macro. That's your 1681 level roughly. So price comes up there. You have your March 2020 event. You get your quantitative easing or massive money printing, takes out those highs, comes up, retests, then one last parabolic leg up. Price collapses over a period of months, bleeds back down into that range or those highs prior to the Black Swan event, hits it, rallies up. And there was kind of your, this is your, essentially your chop of death that, really, the area of the market where, bears get wrecked, bulls get wrecked, and people generally just get bored in these regions. It depends on what type of trader you are. But for all intents and purposes, most people, that some of those areas of chop don't necessarily represent the best areas to be taking trades. Um, More so when you get to the end of the consolidation over in this region, when price starts to break out, you get it's you don't really get that until you break these highs right here, and then price comes up, sets a higher high, comes down, tests off it, doesn't put in a swing failure pattern, and then you get your parabolic leg up. So if I'm just going off pure price on gold, you've got an uptrend pretty much on your higher time frames essentially. So it's hard to get too bearish in that circumstance, but you do have things starting to cool off a little bit on the lower time frames. Um, this could uh, go lower. I'm a little bit inclined to stick with the higher time frames for my bias. Again, but it never hurts to have a conservative approach and wait for the lower time frames to align with the higher time frames. And so, what would it take for that to happen? Well, essentially, if we're looking at the 2 hour time frame right now, so you know, um, well, really, we need to mark off that daily high right here. Um, so if we see that daily high reclaimed, um, you know, that would sort of be game on in my mind. As far as at that point, you have your higher time frames aligning with your lower time frames, and in that scenario, most retracements are going to be a buy. You know, assuming that those retracements aren't coming down and breaking structure and doing that. So despite my bullishness rooted in TA for gold, I think it's um, I would take that with a grain of salt just due to the fact that gold is an asset. Just looking at strictly as an asset has really underperformed pretty much the rest of the market. Um, you know, as far as a store of value, if you were to graph it against the Fed's balance sheet, you would get a pretty lackluster result. Actually, I would assume if you did that, that gold would be in a macro downtrend against the Fed's balance sheet, which to me, um, what it's showing you is that the gold market is, it's staying still. It's maintaining a relatively fixed market cap. At the same time, the Fed's balance sheet and the supply of dollars in the system is growing relative to that fixed market cap. And that's why you would see a downtrend if you graphed it against the Fed's balance sheet. So it's not really doing its job as a store of value on a portfolio level to maintain the rate of, to keep pace with the currency debasement, right? In order to do that, you need to have Bitcoin would be ideal, but also, U.S. equities do that. Um, Gold is just not keeping pace with that. Now, again, I think, considering what we've identified in, if you've paid any attention to the global macro landscape in the financial system, currency debasement, then you know that gold is kind of a close second to what Bitcoin can do is a solution to that big macro problem. And it is the clear second solution. But, so in that sense, I think it's very, it creating a gold position as a hedge against some of the other assets that you own or some of the other trades that you're taking is a very wise approach, assuming that you're taking it as a hedge and using a very low allocation of risk to that hedge. I think that's a very reasonable decision, a very reasonable position to take. Just because gold has been the solution to a lot of the macro problems we've been facing for thousands of years. Um, Even if Bitcoin is, better, it's still new, and so a lot of investors may turn to gold um, during a macro crisis. I mean, it's hard to say exactly how that will play out. So, somebody's, who these old institutions that have been around for hundreds of years, their knee jerk reaction in those scenarios might be to turn to gold. So it's one of those things where, if you hedge yourself properly, you don't even have to worry about being right. You'll make money no matter what scenario unfolds. And really, that's the ideal way to be trading because, it puts you in just a very much more objective state of mind than trying to continually pick winners and going all in leveraged on those winners that you picked. So anyway, just another video broadening the market structure videos to a broader range of asset classes. I'll be I uploaded a video covering coffee futures earlier today, and I'll be sure to get other asset classes up there, and also follow up to some of the existing videos I have. Definitely gold. Gold is one of those where you could build a whole playlist around it. Um, I'm not sure how many uploads I'm going to do following up on gold, but I would expect to see at least a few of those coming through the pipeline soon. So if you like this content, just make sure to like the video, subscribe to the channel, and keep an eye out for some of the similar macro videos and different videos coming through.